Welcome to the Deep Dive. We're here to break down the latest earnings calls, getting you the insights that matter. Today we're tackling GENI Sports and their second quarter 2025 results. This is a really interesting company right at the intersection of sports data, betting, and media. And their latest call definitely gave us a lot to talk about.
It certainly did. Yeah, we'll be getting into their financials, obviously, but also some pretty major strategic wins they announced, things that are really reshaping how sports data rights work. And we'll look at their outlook, too, for the rest of 25 and beyond. The goal here is simple, give you the key takeaways, quick but thorough, so you really understand what's going on.
Okay, sounds good. Let's kick things off then with the headline numbers. Q2 2025, what did we see? Well, revenue came in ahead of expectations. $118.7 million. That's 24.4% up year over year. I mean, that's pretty robust growth.
Oh, absolutely. A strong top line. But what's, really striking beyond just the growth itself is the profitability. Their adjusted EBITDA hit $34.2 million. And that translates to a record margin, 28.8%. That's a full 700 basis points higher than last year.
Wow, 700 basis points.
Yeah, and look at the incremental margin, 57% on that new revenue. It just shows how efficient their operations are becoming, real leverage there.
Okay, strong revenue beat, record margins, operational efficiency. But the market reaction wasn't exactly euphoric, was it? Shares hit a 52-week high initially, right after the release, but then they sort of faded. Closed down about 4.5% on the day.
Yeah, that's right. A bit of a sell the news dynamic, perhaps, and part of that might be tied to the GAAP numbers. They reported a GAAP net loss of about $54 million and a GAAP EPS miss at net of 21 cents.
Right, so how do we square that? Excellent operational performance, but a GAAP miss? What's the story there?
Well, management was pretty clear on the call about this. They stressed that the loss was mainly driven by one-time things, non-recurring items, specifically stock-based compensation, and the accounting effects of those NFL warrants vesting.
Ah, the warrants.
Exactly. So these aren't really reflecting the underlying health or cash flow of the business day to day. It's more of an accounting impact. So yeah, a nuanced picture, but the operational strength seems, well, undeniable.
Okay, that helps clarify the headline figures.
Yeah.
Let's unpack this a bit further then. What's actually driving these results when we look at the different parts of the business?
Sure. So the main engine here was betting technology. That segment just soared, up 30.4% year over year to $87.5 million. That's the core, powering the betting side. Sports technology also showed good growth, up 21.5% to $12.6 million.
And media technology, that seemed a bit slower in Q2.
It was, yeah, up 3.6% to $18.6 million. But, and this is a big but, management really hammered the point that this segment is set for significant acceleration in the second half. Q2 tends to be seasonally lighter for sports, so they expect a big pickup later in the year.
Okay, that makes sense. Now, beyond the segment numbers, what really jumped out at me were these huge strategic wins they announced. It feels like they're locking down some major real estate. We're talking Serie A in Italy, a big chunk of European leagues, and expanding the NFL deal. Which of these feels like the biggest game changer?
That's a great question. They're all significant, obviously, but I think the Serie A and the European leagues deals are particularly revealing. With Serie A, they got exclusive data and streaming rights through 2029. That's one of Europe's top soccer leagues. But crucially, they said they won it based on their technology capabilities, not just by outbidding everyone.
Ah, okay, so technology was the key, not just the highest price.
Exactly. Management explicitly said competitors couldn't make the math work on those deals. That implies their tech gives them an edge, allowing them to structure deals differently, perhaps more cost effectively, or offer more value beyond just the data feed.
That's fascinating. It suggests the whole landscape for buying these rights might be shifting.
I think it is. It's less about just deep pockets and more about having the integrated tech infrastructure. And then add the European leagues deal taking over rights from IMG Arena for thousands of events across 18 competitions. That really solidifies their dominance in European soccer data.
And the NFL deal extension through Super Bowl 2030.
Yep. Extended and expanded exclusive betting data rights, plus those watch and bet streaming rights for games on phones and tablets. They're building a real fortress, like you said.
So underpinning all this is their tech. Genius IQ, they call it.
That's the one. It's their platform using computer vision, AI, machine learning, all the good stuff. We see it applied in basketball, like with FIBA. for real-time optical tracking, making broadcasts better. In soccer, it's powering coaching tools, their Bet Vision platform, that's the watch and bet experience, and even things like semi-automated offside tech for leagues like the Belgian Pro League.
So it's not just about collecting data, it's about enhancing the sport and creating new products with that data.
Precisely. It makes their offering really sticky for the leagues. It's not just a data pipe, it's becoming integral infrastructure that deepens their competitive moat and, importantly, opens up new ways for them and the leagues to make money.
Right, which brings us back to that media technology segment. You said it's poised for acceleration.
Yes, and this is where that tech integration really starts to pay off beyond betting. Management actually raised their full-year guidance for media revenue growth. They initially expected low to mid-teens. Now they're forecasting growth in the low 20% range.
That's a significant jump in expectations.
It is, and a lot of that confidence comes from things like the expanded NFL deal. Genius now has exclusive rights to sell some in-game advertising inventory directly within their BetVision streams. And get this, they said that inventory for the upcoming NFL season is already sold out.
Sold out already before the season even starts. Wow.
Yeah, it shows huge demand for that kind of integrated contextual advertising right within the live game experience.
And crucially, it's not just betting companies buying these ads, right? I saw something about a partnership with a major ad agency, PMG.
Exactly. That PMG deal is really important. PMG represents big brands, many outside of the betting world. Getting those non-endemic advertisers on board is a huge proof point for Genius's strategy to build a much broader media business. They're also adding tools like iSpot measurement into their FanHub platform, giving these advertisers better analytics.
So the vision here is pretty ambitious. Management suggested media could eventually be as big or even bigger than the betting business.
That's the long-term vision they laid out. It's bold, for sure. It signals a potential major shift in the company's revenue mix down the line.
Okay, and supporting that kind of shift often requires the right leadership. There was news on the CFO front, too.
Yes, a key move. Brian Castellani is coming in as the new chief financial officer starting October 1st. And his background is, well, very relevant to this media push. We're talking over 20 years in senior finance roles at places like ESPN, Disney, Warner Music Group.
So deep media and entertainment experience.
Exactly. Experience with global rights markets, large-scale media finance, ad measurement. It aligns perfectly with where Genius seems to be heading strategically. It really reinforces that focus on media growth.
Okay, that makes sense. So pulling all these pieces together, the strong Q2 performance, these big rights wins, the accelerating media outlook, the new CFO, it led them to raise their full-year guidance for 2025.
Correct. They bumped up the numbers. They now expect revenue around $645 million for the full year and adjusted EBITDA around $135 million.
So what does that imply in terms of growth?
That implies roughly 26% revenue growth year over year and about 57% growth in adjusted EBITDA. Really strong leverage there. The implied EBITDA margin is around 21% for the year, and they also expect to generate more positive free cash flow in 2025, with most of it landing in the second half, which is typical seasonality for them.
And this raise is driven mostly by the core betting business momentum and these new partnerships kicking in.
That's what they indicated, yeah. Primarily momentum and the contribution from deals like Serie A and the European League starting to flow through. They also noted it wasn't dependent on favorable FX rates.
Got it. So let's pivot a bit. What does all this mean for you, the listener, maybe someone investing or thinking about investing in this space? It sounds like their tech advantage is becoming a really critical factor.
It really is. This quarter, I think, solidifies their position. Their whole strategy hinges on using technology not just to get data, but to secure these exclusive long-term rights for premium content, Serie A, NFL, etc., on better terms. We talked about how competitors couldn't make the math work for some deals. That's because Genius isn't just bidding cash, they're bidding a technology solution that potentially lowers costs or creates more value for the league. That's the moat.
And we saw that mixed market reaction initially, the spike and fade. But what's the feeling from analysts who follow the company closely?
Sentiment seems pretty constructive, actually. Despite the GAAP miss and the stock pullback on the day, you saw firms like Guggenheim, B. Riley, Needham reiterate buy ratings and even raise their price targets. They seem to be focusing on the record underlying EBITDA, the raised guidance, and the strategic wins.
So looking past the short-term noise towards the operational strength.
I think so, yeah. And the trading volume was huge on announcement day, suggesting a lot of investors were reassessing the story.
Okay, so looking ahead, What are the key things investors should be watching for? Near-term catalysts.
Definitely watch the ramp up of these new big European soccer deals, Serie A and the European leagues. How quickly can they integrate and start monetizing those effectively? The upcoming NFL season is huge, obviously, especially tracking the performance and ad revenue from BetVision. And just generally, are they hitting those updated full-year financial targets? Consistent execution is key.
Did management give any more color on their approach to future rights deals or M&A? Are they still hunting for more?
They addressed that. They said the bar for new rights deals is very high. Any deal has to generate positive returns and be immediately accretive to EBITDA. They're not just chasing flags on a map. They feel their tech lets them be disciplined and get better commercial terms. They see the market consolidating and expect discipline from others too.
And M&A, acquisitions.
They're looking, but again, disciplined. They want things that accelerate growth and meet high cash flow hurdles. But they stress they don't need to buy anything. Organic growth is working well. They do have a share buyback authorization, but it sounds like M&A, if the right deal comes along, is a higher priority for capital allocation right now.
So discipline seems to be the watchword.
Absolutely. Discipline, leveraging their tech advantage, focusing on these sticky, long-term league partnerships. That's their path towards continued margin expansion. They reiterated that long-term target of at least 30% adjusted EBITDA margin.
Okay, interesting stuff. Right, well, this is the deep dive, and you know what time it is. It's our This Is Not Financial Advice segment. And let me repeat, not financial advice. This is purely for informational, maybe even entertainment purposes. Always do your own research and talk to a qualified professional before making any moves.
Absolutely. So with that massive disclaimer in place, let's toss around a couple of, let's call them bold but potentially plausible ideas spinning out of this genius call. And remember, options are involved here, which adds another layer of risk. Okay, first idea. Maybe a long-term bullish play focused on that media technology acceleration. The thesis is that the market still isn't fully appreciating how big this media business could get, especially with sticky ad revenue from things like BetVision, which, remember, sold out its NFL inventory already.
Right, and the push beyond just betting advertisers with deals like PMG.
Exactly. So if you buy into that story, one way to express that view, if you're comfortable with options, could be buying some longer-dated call options, maybe looking at strikes around $18 or $20 expiring, say, 12 to 18 months out. And to maybe reduce the upfront cost, you could simultaneously sell calls with a higher strike price against them, maybe 25 or 28 teamer, creating a call spread.
Okay, so capturing upside of media tech really delivers, but capping the max profit and reducing the initial cost.
Precisely. It's a bet on that media segment growth surprising to the upside over the next year or two. Second idea, this one's definitely more speculative, maybe a bit contrary, and it involves looking at the competition. What about a short-term, maybe event-driven, bet against a competitor who seems more reliant on older data rights models and lacks Genius's integrated tech?
Based on that, couldn't make the math work comment.
Exactly. Genius showed they can win key deals partly through tech, potentially squeezing competitors who rely more purely on paying high rights fees. So the idea is if another major rights package comes up for renewal in the next, say, 6 to 9 months, and one of these less tech-savvy competitors, again, fails to win it or wins it but clearly overpays, that could really hit their stock.
Interesting angle.
So you could consider, again, very speculatively, buying put options on a specific competitor you think is vulnerable, maybe with a 3 to 6 month expiry timed around potential rights negotiations. It's a bet on that dual ballistic market dynamic management mentioned, the strong getting stronger, the weak getting squeezed.
Okay, two very different ideas there. One long-term bullish on Genius's media potential, one shorter-term, potentially bearish on a competitor struggling with the changing landscape. Again, folks, not financial advice. Just food for thought. All right, let's wrap up this deep dive then. To summarize, Genius Sports Q2 25 showed impressive growth, especially in adjusted EBITDA, driven by operational leverage. Key strategic wins, securing exclusive long-term data rights for Serie A, European leagues, and an expanded NFL deal really stand out.
Yeah, and despite that GAAP loss caused by one-off items, the company raised its full-year guidance. They're clearly confident. The big themes are technological differentiation, allowing them to win rights smartly, the significant growth potential they see in their media tech segment, and a clear path towards continued margin expansion and cash flow generation, especially heading into the busier sports seasons.
So a lot going on. It really highlights how technology is fundamentally changing the business of sports data and media.
Absolutely. And maybe the provocative thought to leave you with is this. Is Genius Sports creating a truly sustainable advantage with this tech-led approach? One that competitors just won't be able to replicate easily? Or is this just the first wave, and will the whole industry eventually shift this way, leveling the playing field again? What does this mean for the value of sports rights long term?
Definitely something to mull over. A great question.
Mm-hmm.
Okay, that's all the time we have for this deep dive. Thanks for tuning in. Remember, all this information is for informational purposes only. Do your own due diligence, consult a professional. We appreciate you listening.